Hey everybody, it's Will at VIP Mortgage. It's time for a local lender update. Rates are higher again this week, and this puts us in a range that's kind of similar to where we were before the Fed cut rates. So why are rates going up if the Fed ended up cutting rates in September? And the reason for that is, as I've been saying all summer long, the rate cut, the effects of that cut were anticipated, and the market adjusted before the Fed cut rates. And so they were, as always, trying to anticipate and see where the market is compared to expectations. So we saw the improvement before the Fed cut rates. And since the Fed cut rates, there's been several pieces of data that have come out that make people think that maybe they were over optimistic on where rates are going to be after the rate cut, kind of through the end of the year. And we've seen a lot of economic data between jobs reports, GDP numbers, some of the background numbers like wholesale price inflation that go into the next inflation report. And as these numbers come out, the economy is looking stronger than it did before September. And when the economy is stronger, that may cause the Fed to hold off or change their view on what the rate cuts should be. So when the Fed met in September, they said they do plan to cut more throughout the year, and these economic numbers are showing maybe they're going to pause or revise their plan to cut rates further. So next week is going to be a huge week with this. We get new job numbers from ADP, which is interesting because ADP numbers tend to be more accurate than the BLS numbers. BLS is estimates. ADP is actual statistics. They're looking at real data when they do those numbers, although the BLS numbers tend to affect the market more. So we're going to see ADP numbers, we're going to see the PCE inflation report, which is the Fed's favorite measure of inflation, and a couple of other numbers. This week we saw some numbers come in that make it look like GDP for the third quarter might get revised downward a little bit. That could help us. And these numbers are coming out all before the Fed meets again at the first part of November, and that will probably move the market. If these numbers are flat or below expectations, then the market could rebound a little bit. I'm not saying it will, because right now the psychology in the bond market's a little bit fuzzy, to say the least. And as we're moving toward the end of the year and the Fed giving more comments on whether they're going to continue to cut, whether the pace that they thought they were going to cut is going to be appropriate, all of that is going to be probably volatile in the market. The good news is we're right up against the 200-day moving average, which means there's a reason for the bond market to take a pause on getting any worse from where it is. Statistically speaking, looking at where we're trading, we kind of need some more bad news for it to get worse from where we are. So I think we'll see a little bit of stabilization. Next week is going to be a big week that could indicate to us which direction the bond market is going to go from here, and of course mortgage rates follow the bond market. So there's a lot in the mix. As always, the bond market's trying to figure out what appropriate expectations are and anticipate where the market is heading. That anticipation has turned a little bit more skeptical because the economic data is stronger, thus the rates going up over the last couple of weeks. And when the Fed meets in November, that's probably going to impact the market more than a Fed meeting normally does, because everybody's trying to guess right now what they're going to say. Once they say it, I think we'll have a better idea of where we're heading from here. So hold tight. Things are up in the air, but we'll keep you informed as they develop. If there's anything we can do for you, or we can get you a rate quote for your specific situation, please give us a call at 719-232-7553.